Okay, next we will go to Pramit Mukherjee from Thomson Reuters, please.
Hi, Governor. So from now till the end of the year, there are 3 more monetary policy meetings scheduled. Do you think we can end the year with 3.75%, that is 3 more cuts, or do you think a pause will be more prudent sometime?
Okay, so you want to know where interest rates are going. Okay, let's spend 30 seconds on today's cut before I get to that question. So, we lowered today. Why did we lower today? Look, our indicators are suggesting that broad-based price pressures are easing, and we are increasingly confident that the ingredients are now in place to bring inflation back to the 2% target. This is the second cut. We cut in June, we cut again today. That's brought our policy rate from 5 down to 4.5. So now, looking ahead, if inflation continues to evolve broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate. But we're not on a predetermined path. We're going to be taking it one decision at a time. So what's in our forecast? Well, our forecast has inflation declining gradually. It's probably not going to, that decline in inflation is probably not going to be a straight line back to the target. As I outlined, there are these 2 opposing forces. Excess supply in the economy, slack in the labor market, that's pulling inflation down. But we're seeing ongoing pressures in shelter price inflation. We're also seeing some price pressures in some other services. Those things are holding inflation up. The push-pull of these opposing forces means that decline in inflation is likely to be gradual, and there could be some setbacks along the way. So what we're going to be doing going forward is we're going to be carefully assessing these push-pull forces, and we're going to be taking our decisions one at a time. So as to put it in a sentence for you, it is reasonable to expect further cuts, but the timing is going to depend on incoming data and, importantly, what that data tells us about where inflation is headed.
Okay, we'll go to Randy Thantong-Knight from Bloomberg, please.
Hi, Governor. Quora has been as much as 5 basis points above the target rate again. You started overnight repo operations last week. Settlement balances are concentrated among Canada's 3 largest banks. What's going on in the overnight markets, and is it time to wind down QT?
Yeah, I can ask Carolyn to talk about our monetary policy operations.
Yeah. Thanks for the question, Randy. So as you point out, there's a couple of different things going on in the overnight market. So we've been in with our regular market operations trying to smooth some of those things out. We talked about this at the last decision. I think there was some pressure on overnight rates as a result of something called the basis trade, cash futures basis trade. We still see some of that activity in the market. What's new since then is Canada has moved to a T+1 settlement on securities, so a tighter settlement on securities. That's increased the demand for overnight money too. And as you point out, there's still what we think to be enough settlement balances in the system, but they're not necessarily in the spots they need to be on any given overnight cycle. So all of those things are putting some pressure on Quora, on the overnight rate for money. And so we're doing what we normally do in those situations. We're coming in with market operations to smooth that out. We don't think we're at a normalized state on our balance sheet yet. We think there's more room to go on settlement balances, but as we do get closer to what we think is a normal state, we'll be paying very, very close attention. We're talking to market participants on a regular basis, so we'll be keeping an eye on this.
And we'll be keeping you updated.
Yep.
Okay, Paul Vieira from the Wall Street Journal, please.
Given the the concerns about downside risks in the economy and the need to stimulate growth, was there any consideration given to a 50 basis point rate cut?
Look, in terms of the decision, there was a clear consensus to cut by 25 basis points. There was clear consensus that the expected path of the policy rate is lower, but we're not on a predetermined path. We're going to take it one meeting at a time. So, that was really the main outcome of the meeting. I think the other element was a broad agreement that, yeah, inflation's going to come down. It's going to keep coming down, but progress could well be uneven. There could be some setbacks along the way. These opposing, we got to watch these opposing forces, and we should try and explain that and be clear that we're going to be taking it one meeting at a time.
Next question is from Kevin Carmichael of The Logic, please.
Governor, stagflation is thrown around quite liberally over the last couple of years, but I wonder, looking at this forecast, given the stickiness that you're seeing around service inflation, for example, in wages, and some weakness around growth, if it's not something that's become more of a risk now.
I don't know. I don't think 2.7% inflation is what anybody would call stagflation. I mean, look, we're within our inflation band of 1 to 3%. The message is, we've made a lot of progress. We're getting back into a much more normal zone. If you look at those 4 indicators that we've been highlighting for a while, they've largely moved from red to green. Wages still a bit sticky, so that one's not there yet. Inflation, headline inflation, core inflation have been within the 1 to 3 band now for several months. We expect to see them continue to ease gradually. So, that isn't, to me, that doesn't describe the situation we're in. We're in much more of a situation where we need growth to pick up because there's considerable excess supply, even as we continue to get inflation coming down towards the 2% target.
Greg Quinn from Market News, please.
Good morning. I wondered, in short, how restrictive is monetary policy right now? In a longer sense, inflation has slowed, and some measures of expectations in your own surveys have come down quite a bit in recent months. So is there any argument there that perhaps these rate cuts are only kind of treading water when it comes to the real cost of borrowing?
Look, our assessment is monetary policy is still restrictive. We still need, there's still, look, inflation's still 2.7%, core inflation's about the same. We still need to get inflation down. And so, yeah, we still need monetary policy to be somewhat restrictive. We don't need it to be as restrictive as it's been. We've made a lot of progress. We're confident that the ingredients are in place to get us back to target. It doesn't need to be as restrictive as it's been, and that's why we've cut our policy rate at the last 2 meetings.
Okay, we'll come to this side of the room now, and next I have Najouda Amalise from the Canadian Press.
Hi, Governor. Given you just cut twice in a row, I'm wondering if it's reasonable for Canadians to expect you to continue cutting at every rate decision so long as inflation eases.
Look, I think I've been pretty clear. The expected direction of our policy rate is lower, but we're not on a predetermined path. There are, as I've outlined, there are these opposing forces, and we need to see how they play out. We're going to be, looking at incoming information. In particular, what we want to get out of that information is what is it telling us about where inflation is headed? What is it telling us about whether the economy is starting or going to be picking up? Those are the things that we're going to be looking for. We want to balance the risks on both sides. We are determined to get inflation back to 2%, but we also don't want to weaken the economy too much and have inflation go below our 2% target. So those are all the things we're going to be weighing going forward. We're going to take it one meeting at a time.
Okay, let's go to Alicia Sikirska from Yahoo Finance, please.
Thank you. Governor, despite inflation monitoring, Canadians are still feeling the pain of higher prices and cutting back on spending. How is the bank hoping that Canadians will think about this second consecutive cut and the potential of further cuts?
Well, I think, look, you've got two cuts now, 50 basis points, and even before we started cutting, the anticipation of cutting was starting to reduce five-year mortgage rates. If you have a variable rate mortgage, you'll get some immediate relief. So, look, this isn't a huge change, but first of all, it does mean that Canadians. It means that the cost of carrying debt is going down. Canadians will have more income left for other things. And if we continue to make progress, inflation continues to come down broadly in line with our forecast, it is reasonable to expect some further cuts going forward. As I said, we're not in a predetermined path. We're taking it one at a time. But I think the broad, Canadians are getting some relief there. And I mean, if you look at household sentiment, I think what you're seeing is that it certainly weakened. It's been relatively stable recently. And, hopefully this starts to improve sentiment. As I said, we do want to see growth pick up. We do want to see job growth strengthen. We think there's some good reasons why that's going to happen. This interest rate cut should help.
We've seen Canadians' expectations on inflation starting to come down too. They were stuck pretty high for a long time. That's encouraging to us. It means Canadians are feeling that monetary policy has been working, but it's been tough. And even when inflation comes back to target, price levels are higher, groceries are more expensive. Canadians are feeling that. So, do we feel good that we're able to, we see rates coming down, helping take that pressure off Canadians for sure, but we absolutely need to get inflation all the way back to target too.
Okay, before we go to the phones, I have one last question here in the room, and it is from Annie Bergeron-Oliver of CTV, please.
Hi, I'm just wondering if you can tell me a bit about how much do future rate decisions depend on how and what other central banks like the Fed decide to do when it comes to their own interest rates?
It very much depends on what's going on here in Canada. We have a flexible exchange rate. We have our own monetary policy in Canada. We are very focused on delivering what Canadians need. Obviously, what goes on in the United States in particular has an impact on Canada. In terms of the divergence in policy rates, I mean, our policy rate didn't go as high as the U.S. rate. We've obviously cut now twice. The U.S. has not cut. So that divergence is widening. Yes, there are limits to how far Canadian and U.S. rates diverge. We're still not close to that limit. And, with inflation showing more signs of easing in the United States, my sense is that, that divergence is not going to be particularly serious.
Okay, I have it on very good authority that Anna Pereira is back on the line. So Anna, please come off mute and go ahead and ask your question.
I'm so sorry, I had technical difficulties. So there was a large rise in unemployment from pandemic trough to peak, and it's resembling recessionary periods. And as you said, Governor Macklem, unemployment is not impacting Canadians evenly. So there are people who are very much living under recessionary conditions right now. They're experiencing a recession. Given all of that, do you wish you had cut rates sooner?
Look, we are comfortable with where rates are. we still need monetary policy to be somewhat restrictive. As I've indicated, we are increasingly confident that the ingredients are in place to bring inflation back to target. But one of the reasons for that is that monetary policy is somewhat restrictive. If monetary policy was not restrictive, I don't think we would be getting inflation back to target. We need some restrictiveness. It doesn't need to be as restrictive. That's why we lowered rates. And going forward, if things evolve broadly in line with our forecast, it can be less restrictive. We can, in other words, it's reasonable to expect further cuts in our policy interest rate. But no, we're comfortable with where we are. We've cut our policy rate now at the last two meetings, and yeah, we think that's appropriate.